Good day to our lecturer, Madam Suhaimi. We are from Group 1 want to present about the transfer pricing. Our group consists of 6 members. That's Muhammad Amirul, Hakim bin Azman, Miza Nurdiyana binti Badrul Nizam, Nadia Hanani binti Ahmad Suhaimi, Miza binti Awaluddin, Lorainne Khor, dan Chia Chee. Before start our presentation, I would like to introduce myself. My name is Lorainne Khor, matric number 277199. My group number is L1. I'm going to present the definition and objective of the transfer pricing. What is transfer pricing? Transfer pricing, also known as transfer cost, is the price at which related parties transact with each other, such as during the trade of supplies or labor between departments. Transfer pricing may be used in transactions between a company and its subsidiaries or between divisions of the same companies. A transfer price is the amount charged when one division of an organization sells goods or services to another division. Transfer pricing are used when individual entities of a larger multi-entity firm are treated and measured as separately run entities. It's common for multi-entity corporations to be consolidated on a financial report basis. There are few objectives of transfer pricing. First objective is shifting of profits. Profit is shifting is aimed at reducing the tax liability in a particular country. This can be achieved by reducing profit artificially. It's also aimed at decentralization of production so that the profits are concentrated enough in the region where the production of the goods is undertaken. Second objective is perform evaluation of individual divisions. Transfer pricing can be one of the best options to arrive at the best possible appraisal of the individual divisions. This can help to get efficient decision making. Some of the areas that transfer pricing can assist the performance appraisal and performance management includes appraising the managerial performance of divisions, evaluation of the contribution of the individual entity for the overall profits of the company, and assessment of the worth of each division as an individual unit. The objective is goal congruence. The transfer pricing should be configured in such a manner that the divisional earnings of each of the divisions are quite consistent with the goal of the parent company. The focus should be such that the profit margins of the subdivisions increase while it will not affect the total profitability of the parent company. Transfer pricing needs to be configured in a way where the company profit as a whole to improve. I will give an example of transfer pricing. According to the graph, you can see that Enterprise A manufactures piano in Malaysia while Enterprise B distributes piano from Hong Kong. Both Enterprise A and B are 100% owned by Enterprise Z. Due to Enterprise Z participates directly in the capital of both Enterprise A and B, they are all associated enterprises. When selling piano on the market, Enterprise Z has no control on the price at which piano is sold because the prices are set by supply and demand. Assuming currently the market price for one piano is 5,000 ringgit. However, Enterprise Z does control transactions between Enterprise A and B. Therefore, the internal sales of a piano by Enterprise A to Enterprise B is called a control transactions, and the price charged for this transaction is called transfer pricing. Transfer pricing is important because it will provide opportunities for associated enterprises to transact business between them as the transactions are valued at market price. This will enhance the scope of business and having a positive impact on the parent company as a whole due to internal profits generated by these associated entities. That's all from me. I pass the floor to next presenter.
Assalamualaikum and hi everyone. My name is Miza binti Awaluddin. My matric number is 275820. I'm from Group L1. Transfer price is the amount used in accounting for the transfer of goods or services from one responsibility center to another or from one company to another within the same group. For example, the price used in accounting for the transfer of finished goods from the manufacturing department to the marketing department can also be referred to as transfer price. Transfer pricing is a method of allocating money among several divisions that develop, manufacture, and market products and services together. So today, I would like to representing to you the conditions for most effective operation of a transfer pricing system. For the first condition is the competent people. Managers should preferably be concerned with both the long-term and short-term success of their managerial activities. Managers involved in transfer price negotiations and arbitration must be competent. Next is a good atmosphere. Managers should see profitability as an important goal and a significant component in evaluating their success as evaluated in their income statement. They should believe that transfer prices are reasonable. For the third condition is a market price. The ideal transfer price is based on a well-established normal market price for the exact goods being transferred. That is, a market price that reflects the same characteristic, quality, quantity, delivery time, and so on, as the product to which the transfer price applies. The market price may be reduced to reflect savings occurring to the selling unit as a result of dealing within the organization. When products are transferred from one subunit to another inside the corporation, for example, there is no bad debt expenditure and lower advertising and marketing costs. Although less than ideal, a market price for a comparable but not identical product is preferable to no market price at all. Last but not least is the source independence. Alternatives should exist and managers should be allowed to choose the option that is the best for them. The purchasing manager should be free to buy from outside sources and the selling manager should be free to sell from outside sources. In these cases, the transfer pricing policy simply grants the manager of each subunit the option to deal with either insiders or outsiders. As a result, the transfer price is determined by the market. The marketplace also determines whether to trade inside or outside of the country. If customers are unable to obtain a satisfactory price from an inside source, they are free to purchase from the market. We will continue to turn Chia Chee with advantages and disadvantages of transfer pricing. That's all from me. Thank you.
Hi everyone and good day doctor. My name is Chia Chee, matric number 2777698. My group word number is L1. I am going to present the advantage and disadvantage of transfer pricing. I have listed down 3 advantages of transfer pricing. The first advantage of transfer pricing is cost saving by department. Why say like that? Because transfer pricing is usually lower than the market price of the product and it will result in cost saving as far departments are concerned. For example, if a multinational company produces battery and mobile phone, the mobile phone department can purchase battery from the company's battery department, thereby saving costs for the company's mobile phone department. The second advantage of transfer pricing is transaction transparency. The transfer pricing makes the transaction between various departments transparent. Because in the absence of a transfer price mechanism, the head of the department will set price arbitrarily, causing them to exploit the department that need product and thus creating animosity between departments which in the long term can cause irreversible damage to the company. The third advantage is goods readily available. Since the goods are manufactured in the company itself, as far as other departments are concerned, they don't have to rely on the supplier because the company itself can obtain the goods at any time, thus freeing the company from the exploitation of the goods supplier. For this section, I will explain about the disadvantage of transfer pricing. I have listed down 3 disadvantages of transfer pricing. The first disadvantage is complicated process, which is also the biggest disadvantage of transfer pricing. Unlike market price, which are determined by commodity supply and demand, transfer prices are not only determined by market force but also subject to other organization force, which make this process complicated and suspicious. It is also complicated process because companies need to obtain the detailed information, which include industrial analysis, business information about group company, related party transaction, and determine the market price by implemented benchmarking exercise. To obtain detailed information as I stated just now, it will increase companies' cost to prepare a complete transfer pricing report. The second disadvantage of transfer pricing is animosity between departments. This creates unnecessary rift between departments because the department that supply goods to other departments will feel like they are sacrificing profit by not selling product to the market because the market price is higher than the transfer price. This seems to be a loss for the supplies department by not selling goods to market. In simple words, to let you more understand, suppose you own a house and for some reason you have to rent the house to your relative or friends for 6 months, then your rent will be lower than the market rent because they are people you know and have a close relationship with you, and the transfer price mechanism is somewhat similar with this situation. So this may cause anger and frustration in the company. The third disadvantage is substandard product. If a company follows a transfer price strategy, it will force the department to buy product from within the company. Even if the quality of this product is low, they buy this situation making the product of other department inefficient. In simple words, the transfer price force department hit to buy product from other department from the company even if there are better product alternative on the market. That's all from me. I will pass the floor to the next presenter. Thank you.
Okay, hi, Assalamualaikum warahmatullahi wabarakatuh and a very good day to our lecturer, Madam Faizulaini and all my friends. So I will continue the presentation, but before that, let me introduce myself. My name is Muhammad Amirul Hakim bin Azman, matric number 265103. I'm from group work L1. So I will continue to present about the impact of transfer pricing on divisions and the firm as a whole. Okay, the next part, I will present about the impact of transfer pricing on the division and the firm as a whole. Many companies have independent divisions that transfer goods or services from one division to another. If division managers are evaluated based only on division result using measures such as segmented net income, profit margin ratio, or return on investment (ROI), conflicts can arise, causing managers to take a course of action that benefits the division but hurts the company as a whole. For example, a division manager may decide to purchase a raw material from outside supplier even though the same materials can be produced at a lower cost by another division within the company. But the other division manager refused to sell the material at a reduced price because the manager evaluated based on her division's profits. So in this case, in this situation, we can see that it's important to implement transfer pricing on division and the firm as a whole. So what is the impact of transfer pricing on divisions and the firm as a whole? Okay, when one division of a company sells to another division, both division as well as the company as a whole are affected. The price charged for the transfer good affects both. First, the cost of the buying divisions and the revenue of the selling division. Thus, the profits of both divisions as well as the evaluation and the compensation of their managers are affected by the transfer price. Since profit-based performance measures of the two divisions are affected, example like ROI and residual income, transfer pricing often can be emotionally charged issue. Okay, next, we can see table 4.4 illustrate the effect of the transfer price on two divisions of ABC Incorporate. Division A produces a component and sells it to another division of the same company, Division C. The 30 ringgit transfer price is revenue to Division A. Clearly, Division A wants the price to be as high as possible. Conversely, the 30 ringgit transfer price is cost to Division C. Just like the cost of any raw material, Division C prefer as low a transfer price as possible. So we can see that if the transfer price is increased or high, it will give a Division A more income and increase the ROI. But otherwise, it will affect the Division C by decreased income and decreased ROI. Okay, in addition, the actual transfer price nets out for the company as a whole in that total pre-tax income for the company is the same regardless of the transfer price. However, transfer pricing can affect the level of after-tax profit earned by the multinational company that operates in multiple countries with different corporate tax rates and the other legal requirements set by the countries in which the various divisions generate income. For example, if the selling division operates in a low-tax country and the buying division operates in a high-tax country, the transfer price may be set quite high. Then the high transfer price, that is a revenue for Division A, would increase profit in the division in the low-tax country. And the high transfer price, that is cost for Division C, would decrease the profit in the division in the high-tax country. This transfer pricing strategy reduces overall corporate income taxes. So that's all from me. Thank you. I will pass to the next presenter.
Assalamualaikum and hi. My name is Miza Nurdiyana binti Badrul Nizam, metric number 275714. I am from Group L1. I will proceed with general transfer pricing rules. A general rule that will ensure goal congruence is transfer price equal to additional outlay cost per unit incurred because goods are transferred, plus opportunity cost per unit to the organization because of the transfer. Additional outlay cost per unit incurred because goods are transferred includes the direct unit level cost of the product or service and any other outlay costs that are incurred as a result of the transfer. For opportunity cost per unit to the organization because of the transfer is an opportunity cost is a benefit that is foregone as a result of taking a particular action. Let us move to the example of Kuala Cam Gear Division. The Kuala Cam Gear Division of Outback Outfitter manufacture backpack in its Melbourne plant. First, the Kuala Cam Gear Division transfers some backpacks to Outback Retail and mail order divisions. And second, the Kuala Cam Gear Division transfers some of backpacks to other companies under different labels. Note, suppose the Kuala Cam Gear Division can sell all the backpacks it can produce to outside buyer at a market price of $60 per backpack. Scenario 1. No excess capacity. Here we can see the calculation for outlay cost per backpack and opportunity cost per backpack. After we get the total outlay and opportunity cost, we plus both to get the transfer price. The transfer price is $60. Assuming that the backpack can be sold on the wholesale market for $60 and on the retail market for $70, what is the best way for the company to use its limited capacity? All the backpacks should be transferred to the retail division to take advantage of the additional $10 contribution margin, which contribution margin of retail division $30 minus with contribution margin of external market $20. The Cam Gear division will not be hurt since the transfer price equal to the alternative wholesale price, which is $60. Okay, we move to what should the company do if the retail division receive an offer to sell all its backpack at $55 each. The retail division should reject the offer because all the backpack could be sold in the external market at $60, yielding a higher contribution margin of $20. Scenario 2. Excess capacity. With excess capacity, transferring a unit to the retail division does not affect sales to external customer. So, the transfer price will be $40 because $40 of total outlay cost plus with zero total for opportunity cost. Okay, for scenario 2, what should the company do if the retail division receive an offer to sell all its backpack at $55 each? They must accept the offer. The retail division will realize a contribution margin of $15 on each backpack sold at the special price, which the $55 price minus $40 transfer price. The difficulty in implementing the general rule. First, the opportunity cost may be difficult to measure. Second, the external market may not be perfectly competitive. And third, there may be no external market. Fourth, the goods or services may be unique. Fifth, special equipment may be needed to produce the transfer good. And last but not least, interdependency among several transfer products or services. That's all for general transfer pricing rule. Thank you.
Hello and good day to Madam Suhaimi and everyone. First, I would like to introduce myself. My name is Nadia Hanani binti Ahmad Suhaimi. My metric number is 275775 and my group work is L1. For my part, I would like to briefly explain about types of transfer pricing. Generally, companies can determine transfer pricing through three different ways, which are: first, market-based transfer pricing; second, cost-based transfer pricing; and third, negotiated transfer pricing. Although each of these methods provides a different approach and give different pricing, they all share one similarity. The similarity is transfer pricing represent an intra-company market mechanism. We will now discuss each types of transfer pricing. The first type of transfer prices is market-based transfer price. Market-based transfer prices represent market conditions and simulate the market within the company. The advantage of market-based transfer prices is they support and implement corporate strategy and allow performance measurements of responsibility using market-oriented data. The second type of transfer prices is cost-based transfer prices. Depending on one's definition of cost, cost-based transfer prices can provide a variety of figures for determining intra-company trading. Cost-based prices are the most common type in practice because they represent an alternative if a market price does not exist. Lack of market price might occur because the transferred products uses patented designs owned by the parent company. In accounting terms, costs can be defined in a variety of ways. This includes actual versus budget or standard, marginal versus absorbed full cost, and whether one uses pure cost or cost plus to determine transfer prices. The third and last type of transfer prices is negotiated transfer prices. Companies can determine transfer prices by way of negotiation. Negotiated transfer prices simulate the market within the company. These prices can be determined in a situation that is characterized by highly autonomous and independent subunits. It implies that responsible managers have the option to refuse the internal business. This process is similar to way of negotiating with regular customers. Headquarters can have different ways of influencing this decision. This include requiring approval, having the right to reject, having veto rights, establishing procedural rules, and so on. As a result, it is difficult to assess whether negotiated transfer prices can fulfill the coordinator and profit allocation function. This is because they depend on the negotiating power and negotiating skills of the individuals that involved in the negotiation process. That is all from me. Thank you so much.